Competition is fierce, and China's EV market right now is a knife fight. What I'm watching closely in Q4 is, can they hit 150,000 delivery? Do margins actually expand to that 16 to 17% range? So if both of those things happen and they achieve profitability, this stock could actually moon. That's just potentially. I'm not gonna give financial advice. It's up to you to have your own beliefs and do your own research. Just speaking from my perspective, I'm a news guy. But obviously, if they miss or margins don't happen, we're gonna have a big problem. What's going on, everyone? My name's Obi, and welcome back to the Courtside Financial Podcast. Today is October 8th, and boy, do we have some interesting updates today for you guys. As you guys know, I'm a NIO bull, but today, like every other day, I'm not here to blow any smoke. We're gonna look at what's actually happening with the numbers, because that's what matters at the end of the day. So here's the headline. HSBC just nearly doubled their price target on NIO. We're talking about a 90% increase. That's from $4.10 to $7.80. Now, before we start celebrating, let's be real. We closed at $7.50 yesterday. So the new target only gives us about 4% upside. Not exactly moonshot territory, but here's why it matters more than the number itself. This is the same HSBC that downgraded NIO from buy to hold back in January, slashing the price target from $7.20 to $4.50. For 4 straight years, they've been trimming NIO's target as the stock fell from the legendary $66.99 peak back in January 2021. So when a bank that's consistently been bearish suddenly reverses course, this dramatically makes you pay attention. Not because they're suddenly geniuses, but because something changed, and that something is execution. Look, in the past 3 months, NIO's US listed shares have more than doubled. Just in the last 30 days alone, we saw a 31% jump. That's not hype. That's the market responding to actual delivery numbers. September was NIO's second monthly consecutive delivery record with 34,749 units delivered. And that's across all 3 brands. So let me break that down for you. The NIO brand delivered 13,728 vehicles, and the Onvo brand delivered 15,246 vehicles. Think about that for a second. The sub-brand that just recently launched is already outpacing the main brand. That's exactly what we were hoping for and wanted to see. The Onvo L90 launched in late July. We're talking about a 3-row SUV positioned to compete in the mass market. By late September, they'd already delivered 20,000 units. 2 months from launch to 20,000 deliveries, that's Tesla Model Y levels of traction in the Chinese market. And Onvo's chief, Fei Shen, isn't being shy about it either. He's targeting 150,000 units in October alone. If they hit that, we're looking at a genuine volume driver that could completely change NIO's economics. But here's a story that really caught my attention. The 3rd generation ES8. This is NIO's flagship large SUV that launched on September 20th. Management said that they're planning to produce 40,000 units this year, and warned that boosting capacity beyond that would be difficult. The orders opened at the end of the launch event. Those 40,000 units, they sold out in 9 minutes. I'll say it again, 9 minutes for a year's worth of production. As of right now, if you order an ES8, you're looking at a 24 to 26 week wait time. Your car shows up in April 2026. That's not a manufacturing problem. That's a demand problem. The good kind, though. NIO even started using their 100 kilowatt hour batteries to accelerate their ES8 deliveries, which temporarily constrains their battery swap station supply. They're literally cannibalizing their swapping network to fulfill orders. That's how strong the demand is. Now here's where things get interesting from an investor perspective. NIO is targeting 150,000 units for Q4, and that's across the group. NIO, Onvo, and Firefly. The L90 from Onvo and the ES8 from NIO, they're expected to drive most of these deliveries. If they hit that number, we're looking at real economies of scale kicking in. HSBC's thesis is simple: higher volumes equal higher margins in the short term. And NIO needs that margin because the CEO, William Li, confirmed back in April that they're targeting profitability by Q4. Not next year, not eventually, but this quarter. And this is where we need to be a little bit critical here, because the margin picture in Q2 was not so pretty. Vehicle margin came in at 10.3%, down from 12.2% just a year ago. Despite delivering over 72,000 vehicles, up about 25% year over year, and vehicle sales of $2.25 billion in revenue, vehicle margins compressed. And the why behind this is because NIO's selling more lower trim, lower priced vehicles. Materials cost per vehicle came down, which helped a lot, but not enough to offset the pricing pressure. You're growing volume at the expense of per unit profitability. That's the trade-off that NIO's facing. Here's the thing, and this is crucial, NIO is projecting 16 to 17% vehicle margin across the entire group for Q4. That would be a massive potential jump from the 10.3% that we saw in Q2. And so how do they get there? Volume on higher margin vehicles like the ES8 and the Onvo L90 hitting scale in production. Q4 will be the actual first full quarter with both of these models on the market. Let's put things into context though. Li Auto reported 19.4% vehicle margins in Q2, best in class. XPeng came in at 14.3%, which is actually pretty impressive considering they were at 6.4% a year ago. So NIO at 10.3% is behind, but if they hit that 16 to 17% target in Q4, then they're suddenly in the mix with XPeng and closing in on the gap with Li Auto. This Chinese EV market is brutal right now. Price competition is intense, and as HSBC noted, the long-term outlook for sustainable margins and volume growth, it remains uncertain. You can't ignore that. But let's talk about the elephant in the room. NIO raised $1.16 billion through an equity offering in mid-September, issuing over 209 million shares. Dilution hurts, no question, but the company was explicit about why: strengthening the balance sheet and continuing to invest in products and battery swap technology. So here's my take. If you're going into a massive production ramp, 150,000 units, and you're expecting profitability in Q4, you might need a cash cushion. The timing makes sense even if dilution never feels good as a shareholder. From a valuation standpoint, my camera just died, but from a valuation standpoint, NIO is trading at 0.87 times sales versus the industry average of 0.5 times sales. So from a value perspective, on paper, you're paying a premium for NIO today. When we look at the stock purely, it's up 72% year to date versus the industry being up 5.7% year to date. So clearly the stock market is pricing in execution when it comes to NIO. So far, NIO's delivering on that. Literally, we'll have to wait and see what happens in Q4. Do they actually hit the targets, the lofty targets that they put out there that many people are questioning? We just gotta wait and see. So where does this leave us? Look, I'm long NIO. I believe in the battery swap infrastructure. I think Onvo has mass market appeals, and the ES8 demand is undeniable, but I'm not gonna pretend there aren't any risks. Margin pressure is real, competition is fierce, and China's EV market right now is a knife fight. What I'm watching closely in Q4 is, can they hit 150,000 deliveries? Do margins actually expand to that 16 to 17% range? So if both of those things happen and they achieve profitability, this stock could actually moon. That's just potentially. I'm not gonna give financial advice. It's up to you to have your own beliefs and do your own research. Just speaking from my perspective, I'm a news guy. But obviously, if they miss or margins don't happen, we're gonna have a big problem. HSBC moving from consistently being a bear to cautiously optimistic tells me one thing: the narrative is shifting, but the conviction isn't there yet. They're waiting to see execution, and honestly, who could blame them for having that stance? For NIO bulls like us, this quarter matters. This is the most important quarter ever. The products are in the market. Demand is there. Now it's about execution and proving the business model works at scale. That's it for today, Courtside family. Keep your eyes on those October delivery numbers. And if you found this video useful, helpful, insightful, at the very least entertaining, make sure to hit the like button, share the video, leave a comment down below. All your engagement really does go a long way in helping out the channel. And guess what? We'll see you in the next episode. This is Obi signing off of the Courtside Financial Podcast. Thank you. Bye.